Hi everyone, welcome back. In this session, we're going to see the basic definition of discounted cash flow valuation and also actually value a bond using the discounted cash flow valuation technique. The discounted cash flow valuation starts with a very simple question of why are you buying an asset? Now, the obvious answer to that is you're buying an asset because you expect certain benefits to accrue to you after purchasing the asset, right? For example, let's say you're superstitious and you also see a haunted house. Now, if you buy that haunted house, one, you won't be able to find any tenant because nobody would be willing to stay in that house. Two, you wouldn't be able to sell that asset to anybody because, again, you're not going to find any buyer. And three, since you are superstitious, you're probably not even going to stay in the house, right? So the future benefit that you're going to get out of buying that haunted house is actually nothing. How much are you going to how much are you willing to value that asset for? The answer should be zero because it does not benefit you at all. Therefore, the maximum price that you're supposed to pay for a haunted house is supposed to be zero, right? Now let's consider an equity share of a company. Let's say that company is a money losing company. By money losing company, I'm saying that it's actually having negative cash flows. It's making losses year after year, year after year. And you also expect that to occur in future, right? I'm not only talking about the past, I'm also talking about the future. Let's say you expect it to be a money losing company throughout your life, right? At least so long as you live, you expect that asset to actually keep generating negative cash flows and also keep making losses. How much are you actually going to be paying for that share? The answer should be you should not be paying anything, right? Because if by acquiring that share, you're neither going to have dividends because the company is actually losing money. And similarly, you're not going to have any capital appreciation because the share itself derives value from the profits that the company makes, right? So obviously the value or the price that you're willing to pay for that asset for a share where the underlying company is actually losing money is actually supposed to be zero, right? So repeating my first statement, discounted cash flow valuation technique says that the value of any asset is nothing but the benefit that you receive from acquiring that asset. Now, giving a more formal definition to it, it says that the value over here also is referred to as intrinsic value of an asset is the present value of all the future benefits. In terms of future benefits, we are always referring to cash flows. Like in capital budgeting, how the emphasis was always on cash flows. Similarly, even under the discounted cash flow valuation, the emphasis is on cash flow. I think if you actually see the name of the topic itself, it says discounted cash flows, right? It doesn't say discounted profits or any other term, right? So future benefits are always quantified in terms of cash flows. So the value of an asset is the present value of all the future benefits or all the future cash flows that you are expected to derive from this asset, right? If you are buying an asset, you expect certain future benefits meaning future cash flows. You're supposed to discount those future cash flows into today's terms, and that is actually the value of the asset. Okay. Now to discount, you need a required rate of return, right? In capital budgeting, you use the particular required rate of return. Similarly, when you're valuing any asset, you need a required rate of return. We will have an extensive discussion on required rate of return in the next lecture. But for now, let's assume that the discount rate that we use is actually something which is called as the required rate of return. We do not know what that required rate of return is as yet, but we will soon learn, right? This is also known as the intrinsic value. So if I just repeat it once again, the intrinsic value of any asset is the present value of all the future cash flows that are expected to be received from that asset. Now, first question, why are we using the term present value? Obviously, it's because of the time value of money concept that you would have probably learned in your basics. 1 rupee received after 1 year is not the same as 1 rupee that you receive today, right? So if I have an asset which is generating 1 rupee at the end of year 1 and 1 rupee at the end of year 2, then obviously the value of that asset is not rupees 2, it's less than rupees 2 because the 1 rupee that I received after 1 year is actually less than 1 rupee today, which means it would be about 0.9 something. The 1 rupee that I'm receiving after 2 years is obviously going to be much lesser, right? So I cannot add 1 plus 1 and say that the value of the asset is 2. I need to discount them into today's terms and then take a sum of it, right? So we are taking a present value because of the simple concept of time value of money. Now, the next challenge that we have is we have to quantify the future benefits. For instance, in case of land and building, the future benefit is generally the rental income, right? Because when you buy an asset, when you buy a house property, you expect to let it out to somebody, and you expect to collect that rent from that house property, right? So the future benefit for you is actually in the form of rental income. When you're buying a share, your future benefit is going to be in the form of dividends, right? And when you're buying a bond, your future benefit is going to be in the form of coupon and face value that you receive upon maturity. Actually, the better term to use over here would be the redemption value. But in 90% of the cases, the face value is generally equal to the redemption value. And therefore, you for the ease of convenience, you just say face value received on maturity. But what you actually receive on maturity is the redemption value, which need not be equal to the face value. There can be a premium as well, right? So in case of bonds, the future benefit or the future cash flow is nothing but the coupon and the face value that you receive on maturity. Now, if you carefully notice, when defining the future benefits for land and building, I did not mention the fact that the future, that if you intend to hold the land property for 10 years, at the end of 10th year, you're actually going to sell that house property and actually receive the sale consideration. In case of shares as well, you receive dividends so long as you hold the share, but once you dispose the share, you expect to receive certain sale proceeds. I intentionally have not quoted, the sale proceeds expected on selling the house property or the sale proceeds expected on selling of the share. I have not quantified it as future benefit for a particular reason, which we will discuss it later on, right? But for now, since the topic of discussion is bonds, let's just have more emphasis on bonds. It's basically the coupon and the face value that is expected to be received upon maturity, right? So now if you actually also see a difference between land building shares and bonds, in case of bonds, generally the coupon is fixed, right? Because you have the terms and conditions which are fixed upfront, which says the coupon will be 8% per annum paid every 31st of December, hypothetically, right? Whereas in case of shares, you do not have any contractual arrangement wherein you know that you're going to receive fixed amount of dividends after every certain period, right? Sometimes if the company is doing extremely well, it may pay a dividend of 100 rupees. If the company in a period like COVID has absolutely no profits, it may not pay dividends at all, right? So dividends are actually uncertain, whereas in case of coupon, it's actually relatively certain. Same with the case of rental income. Rental income is actually somewhere between shares and bonds, because rental income, you generally enter into a contract for a specified period. Let's say you enter into a contract for 5 years, hypothetically. So the rental income that you're going to receive in the 5 years is actually fixed, right? But beyond 5 years, the rental income that you're going to receive is actually uncertain. So it has a component of bond as well as it has a component of share. The uncertain rent that you're going to receive beyond 5 years is a characteristic which is similar to shares, whereas the certain element that you're going to receive during the term of the contract is similar to bond, right? In case of bonds, again, face value or the redemption value is known at the time of issue of the bond. Whereas in case of a share or in case of a house property, you actually do not know how much you're going to sell that house property or how much you're going to sell that share for, right? So again, over here, there's an element of uncertainty in case of land and building and shares, whereas there's more certainty in case of bonds, right? Now let's take an example. Let's say there's a bond which was issued about 7 years ago, and the total maturity or the total tenor of the bond was 10 years, which means at the time of issue, the total maturity of the bond was 10 years. Out of that, 7 years have passed, right? So now there are 3 years left for the bond to mature. Let's say hypothetically that the coupon is 5%. The face value, which is also the redemption value, is $1,000, right? Just to reiterate the fact, if the redemption value and the face value are not equal, the coupon is always calculated on the face value and not on the redemption value. Please keep that in mind, right? And now let's assume that the required rate of return is actually 4%. Okay, this we have assumed for now, and we're going to have an extensive discussion on how to calculate the discount rate or how to arrive at the discount rate in the next subsequent lectures, right? So now if we go back to the definition, I said that the value of any asset, in our case, we are valuing a bond. Therefore, the value of a bond is the present value of the future cash flows. The future cash flows are nothing but the coupon that you expect to receive and the redemption value that you expect to receive on maturity. right? So the value of the bond should be equal to the present value of all the future coupons and the future redemption value that you expect to receive on maturity, discounted into today's terms using the required rate of return, right? So I have the future benefits, which are the coupon and the face value. I have a required rate of return. All I'm supposed to do is discount it to today's terms. Okay, now the most important thing is I have said future benefits, right? Future benefits refers to the cash flows that I'm expected to receive over the next 3 years. I am not going to be concerned absolutely about the cash flows that were paid in the last 7 years, because I am buying an asset today because I hope that it benefits to me in future, right? I'm not buying an asset today because it has benefited somebody else in the past, right? When I buy an asset, I look at what I'm going to benefit out of it in future, right? So that's why we're always looking at the future cash flows, always at the remaining cash flows. So what's actually not relevant for us is the total tenor of the bond. What's not relevant for us is how many years the bond was issued ago, or how many years has it been since the bond was issued. What's actually relevant is the remaining period of the bond, which is 3 years, right? So we are actually required to calculate the present value of the future coupons and the face value received at maturity. For a period of 3 years, the coupon is going to be received for a period of 3 years, and we are going to discount this using the required rate of return. So this is actually almost like a similar capital budgeting exercise. I will also share the similarities between capital budgeting and bond valuation in a subsequent video, but let's start off now. So I'm going to solve it on an Excel. Let's say I have the first column as year, the second column is cash flow, the third column is present value factor at 4%, and the fourth column is discounted cash flow, right? Now I have the total remaining maturity of the bond is 3 years. So I have 1, 2, and 3 years. The coupon that I'm actually going to be, or let me just insert another column for the type of cash flow for the sake of convenience. I'm going to receive coupon of $5, right, every year. And I'm going to receive it for a period of 3 years. And at the end of third year, I'm also going to receive redemption value of $100, right? So I'm going to receive 3 years coupon and the redemption value of 100 at the end of third year, right? The present value factor is nothing but 1 divided by 1.04, right? It's 1 divided by 1.04. This is the present value factor for the first year. The meaning of this is $1 received at the end of year 1 is equal to 0.96, which is 0.96 as of today, right? $1 received at the end of year 1 is equal to $0.96 as at today. Now the present value factor for the year 2 is obviously going to be equal to 1 divided by 1.04 whole part 2, right? Which is 0.924. The meaning of this is $1 received at the end of year 2 is equal to 0.93 or $924 as at today, as at t equal to 0. Now the last one is 1 divided by 1.04 whole part 3. Apologies, I forgot to put a bracket here. So that's 0.89. The meaning of this is $1 received at the end of year 3 is equal to $0.89 today. Now, obviously, for the next row also, it is going to be 1 divided by 1.04 whole part 3, because this is also at the end of third year, right? So I can just take the above value. Now, the discounted cash flow will be 5 multiplied by the present value factor, which is 5 multiplied by this one. And now I can just drag this formula into the next few rows. So this means that $5 received at the end of year 1 is equal to $4.81 as at today. $5 received at the end of year 2 is equal to $4.62 as at today. 105 received at the end of year 3 is equal to 93.34. The total is 93.34 as at today. Now, this column is representing cash flows standing at today, right? It would be grossly incorrect if I actually take the sum of all the future cash flows without discounting it, okay? I should not be saying that the value of this bond is actually 115, okay? Because these cash flows are standing at different points in time. But what I'm supposed to do is, I'm supposed to take the sum of this column wherein all the cash flows are actually standing at t equal to 0, and then find the value of the bond. Now the value of the bond is 102.78. Okay, this is actually value of the bond. Okay, this, remember again, is the intrinsic value, meaning the true worth of the bond. This need not be equal to the price at which the bond is actually trading in the market, right? The price at which the bond is actually trading in the market could be something else altogether. Okay, that's more driven by demand and supply, which again is driven by humans. Humans are driven by emotions. So God knows what the market is actually pricing the bond at. Okay, but this is actually the value of the bond. You will then compare this value of the bond with the market price or the price at which the bond is actually trading, and then take a decision of whether you want to buy the bond or whether you want to sell the bond, right? Now, if I come back to the PPT, okay, I'm sorry, I think I made a mistake. It's supposed to be actually 50 over here. In case you actually realized it when I was doing, well and good. So let's say the value of the bond is actually 1027, all right? Now let's say the bond is actually trading at 960, right? You think that the bond is worth 1028, whereas the bond is actually trading at 960, right? And this is the current market price. Now the question is, what would you do? Number one is, if you consider that your valuation is actually correct, right? Which means if you think that the future cash flows that you have quantified are correct, and also your required rate of return estimation is right, then that means that this 1027 in your view is actually the correct worth of the bond, right? So the bond is available at 960, but you think that it is worth 1027, right? Are you supposed to buy or sell the bond? The answer is obviously you're supposed to buy the bond, because the bond is available cheap, right? So you buy the bond. Or option number two, probably the market is right and you are probably wrong. Your estimation of the value of the bond is probably wrong. Reason being, the future cash flows are obviously correct because these are taken based on the contractual arrangements of the bond. But probably there could also be a scenario that you have gone wrong with the estimation of discount rate. Okay, so it's always better to actually go back and have a look at what the discount, and this is in practice, right? I'm not saying that in exam you're supposed to go back and relook at your answer, but in reality, you can probably have a relook at the assumptions that you have made, assumptions or the estimations that you have made. And one important estimation that's made in bond valuation is the discount rate that needs to be used. Okay, so but if assuming that all your estimations and inputs are correct, then the true worth of the bond is 1027. The bond is available in the market at 960. You're supposed to go and grab that bond, right? Now, alternatively, if the bond is available at 1100, let's say, are you going to buy the bond or are you going to sell the bond? You think that the true worth of the bond is 1027. It's available in the market at 1100, right? You should just jump and click that sell button and dump as many bonds as you have, provided you think that this value estimation is correct, right? So value estimation is like a garbage in, garbage out process, which means if the inputs are garbage, the output is also going to be garbage. Inputs over here being the future cash flows and the discount rate. Future cash flows is obviously not garbage. The discount rate could be garbage, right? So if this input is wrong, then obviously your output is also going to be absolutely wrong, right? Other than this also, Excel has actually a very beautiful method of actually valuing bonds or valuing cash flows in that sense, to be honest. Okay, so Excel has a function called as equal to PV, and then it asks you for the input. It's asking you for the rate. In our case, the rate was 4%. So I write 4%. And then it's asking NPER. NPER refers to the number of periods. The number of periods in our case was 3 years. And then it's asking PMT. PMT refers to payment, right? The payment per year was 50. And then it's asking you for the face value. FV refers to the face value, which in our case was 1000. And then it's asking for the type of cash flows. Remember, cash flows can occur at the beginning of the year or they can occur at the end of the year, right? Here in our case, we assumed that the cash flows actually occur at the end of the year, which is true in case of a bond. You generally receive coupon and the face value at the end of the year, right? So 0 refers to the end of the period and 1 refers to the beginning of the period. So we have to click 0. And then if I actually close the bracket and press enter, it's actually showing me 1027.75, which is the same as what we got here. And the beauty is it's actually showing you as a negative signage. And the reason it is actually showing you as a negative sign is because it's saying that you have to shell out or you have to pay 1027 in order to receive 50 and 1000 at a future point in time. You're supposed to pay 1027, and that's why it's denoting it as a negative, meaning cash outflow to receive 50 and 1000 in future, right? Now let's do a quick recap of what we actually saw so far. We saw that the discounted cash flow valuation states that the value of an asset is the present value of all the future benefits that you are expected to derive from that asset, discounted at the required rate of return. And then we understood why we're taking the present value, and also we saw what the future benefits actually mean. In case of bond, which is the topic for discussion, future cash flows or future benefits basically mean the coupon and the redemption value that you expect to receive on maturity. Remember, the emphasis is on future cash flows because you always acquire an asset to benefit in future, right? And then we saw a very quick example wherein a bond, we had a 3-year maturity of the bond. We had a coupon of $50 and a redemption value of $1,000 and the required rate of return being 4%. We calculated the value of the bond to be 1,027, 1,028. We then compared it with the current market price and then decided whether to buy or sell the bond. All right. Thank you. Let's see you. I'll meet you in the next lecture. Bye.